Well, despite remaining in positive territory in 2009, East Africa's growth momentum has undoubtedly been stalled by the ongoing global economic downturn. The level to which each of East Africa's economies has been affected by the trade and financial shocks introduced by the crisis speaks directly to their relative economic vulnerability or openness. And to take a look at this region's vulnerability to the global economic downturn, I'm joined by Simon Freemantle, senior economist at CFC Stanlib Bank from our studios in Nairobi. Simon, thank you so much for joining us. Most of the factors that show a region's economic vulnerability, like FDI, economic openness, dependence on imports, are showing declines in East Africa. So what should the region be doing to counter these vulnerabilities?
I think a lot of what needs to be done is being done. One of the, just to go back a level, the extent and the level and the speed of economic integration which has happened across the globe in the last 10, 20, 30 years has rendered all markets vulnerable. It really is just a matter of how you respond to cyclical downturns. Now, this downturn is obviously particularly acute, synchronized and particularly deep. What East Africa should be doing, I think, in my opinion, is diversifying its export products and export markets. Increasing the amount, or at least the diversity of industrial products available in the internal market, so that not all of those products are being brought in from abroad at increased cost. And you've seen a great amount of that cost going up significantly when exchange rates have depreciated, which is another symptom of the financial crisis. So on the trade side of things, it really is just in terms of diversification. And in East Africa, while Kenya has made great strides in terms of diversifying its economy in general, exports remain heavily dependent on horticulture and agriculture, and that is across the region, as well as to select markets largely in the Eurozone. And we've seen as soon as European countries enter recession, demand drops significantly, and of course then your export products are going to suffer. So in terms of the trade, it's diversity. In terms of the financial flows, East Africa and across sub-Saharan Africa still rely quite heavily on portfolio flows, on aid, on remittances, on all of these diverse flows of finance from abroad. A large amount of them come from the advanced economies, and we've seen that the downturn has knocked these flows quite significantly. So it really is just a matter of creating broader regional flows, African flows of these investments, and channeling investments from the region into projects, into the industrial growth in the region, so as there's less reliance on the foreign sources.
What should governments be doing in terms of closing the gap between exports and imports? Because this will definitely help in maintaining current accounts and the forex reserves in East Africa.
Sure, of course. I mean, it's important to mention that the trade deficits in East Africa, and we've seen Kenya, Uganda and Tanzania's trade to GDP ratios increasing quite significantly. Kenya's is looking to exceed 100% in the next 1 or 2 years. Now, outwardly in the recession, this looks like a negative thing because it makes Kenya more vulnerable to trade fluctuations and demand fluctuations in its key markets. But the core of it is not a negative thing. The trade to GDP ratio is really a sign that these economies are integrating further into the global market. It means that their exports are going further abroad, and the imports, which are of course of higher value goods, are being used for industrial expansion. They're being used for infrastructure. You saw across the region in the budget announcements for the 2009-2010 financial year, once again, a heavy focus on infrastructure, and a large amount of that infrastructure is being financed by imports from abroad. So it's not necessarily a negative thing, and this trade deficit is going to continue for some time until these economies are able to source those goods needed for industrial and infrastructure expansion from their local markets, and it'll be some time before that happens. So on the one side, it is a negative element that exposes these economies during a downturn, but one needs to also see that from a balanced perspective of what the imports are being used for, and these are all being used for medium to long-term growth strategies.